Hello, hello. Welcome to the tax panel for the end of the year. I am saying it's 2021 because taxes change every year, and you need to double check and make sure whether the panel, what they discussed today, will work in the future. Tim Landry has said he would like to do a little introduction quote for the panel today.
Well,
So,
the truth
Tim,
is Peggy's putting me on the spot, but that's
I
okay.
am.
No, we had talked about this and I just wanted to share it. This actually comes from Mark 22, verse 21. And it says, so give back to Caesar what is Caesar's and to God what is God's. But it doesn't say to give a penny more. So that's our introduction into paying taxes.
Exactly. Thank you, Tim, very much for that. And
You're
we did
welcome.
have someone sent in and said, how could you set up an investment from the beginning to take advantage of the tax laws? So while you're sharing with all the questions, we'd like you to keep that in mind. And we have a moderator today who's actually quite brilliant, and that's our own Cliff Morgan. So Cliff Morgan, please take it away and ask our panelists to introduce themselves, and then we'll go to Q&A.
Well, we're very excited to put together this tax panel today. We brought some specialists to our audience. What I'd like to do to get started is have each one of our panelists just take a couple of really quick minutes and discuss with our audience who you are and what level of expertise you bring to our audience. And then once we've done that, we'll start accepting questions in either chat or you can raise your hand digitally and we will address each one of your questions one at a time. And with that, I'd like to turn that over to our first panelist. Let's say Kristen.
Well, hi, everybody. My name is Kristen Berman, and I am the Chief Operating Officer of Redwood Tax Strategy. We're a national tax reduction planning firm, and we have offices in all 50 states. We have all virtual consultations. We provide complimentary consultations. And then we take it from there. We have tax advisors in every aspect of tax. I am not the tax professional. I oversee a lot of the tax professionals. I personally have a financial advisor background. So that's what really brought me to this company, is all the questions that I would get in my practice. And I kept finding that when I'm really trying to help my clients be most efficient with their assets and their building of their assets and their cash flow techniques, that everything comes down to tax efficiency. So have teamed up with this expert team, and happy to be a resource for anyone that I can be there for.
Thank you.
Thank you.
Sarah, would you mind taking a moment and introducing yourself to our audience?
Hi, everyone, and thank you for having me on today. It is a pleasure. My name is Sarah Waterman. I am the Director of Client Services for Veracity Advisors. If any of you own any commercial or residential rentals, then I'm the person that you call. It's that easy. We're a specialty tax company, a firm, and we specialize in cost segregation studies, fixed asset studies. Really, we're there to uncover fixed asset opportunities to help increase your cash flow right away so that your building is more profitable today. That's it.
Thank you so much, Sarah. Gary, you're on. If you would just unmute yourself and tell us a little bit about yourself, your expertise, and acquaint everyone with you.
I am coming to you from beautiful downtown Los Angeles. Well, it doesn't look like it back there. I just finished a gala for someone who's retiring after running one of our organizations for 25 years. So I feel older, and also had a couple of glasses of champagne. No, let me tell you about, I was an insurance agent for 20 years and then ran into this program of research and development tax recovery. It's really quite amazing to help business owners who do not know about this program Their CPAs generally don't know about the program. I've always given the description that we're like a brain surgeon. Your regular doctor, unless anybody remembers Johnny Carson, Dr. Irwin Corey with the crazy hair, unless they're crazy, they don't operate on your brain. But we do something very special that we can defend, and that's what I'll tell you about.
Thank you so much, Gary. And I believe we have one more. Dylan, if you would just come on, unmute yourself.
Hey, thanks for having me. I'm an RA and private wealth manager with Sabre Private Wealth Management. We're a multi-level family office CFO. Primary function of what we do is taxes and tax mitigation and avoidance, but we handle anything and everything in the financial sector.
What is RA, Dylan?
Investment advisor.
Thank you.
Thank you so much, Dylan. Okay, we'll go ahead and get started. Before we do, just a little disclaimer. It is strongly recommended that anything you hear today is for educational purposes. Strongly recommend that you seek the advice of your own personal tax advisor before implementing any of these strategies. The strategies that will be described today might be a little out of the box from what you may be familiar with, and if properly implemented, could potentially save you money, but it is recommended you speak with your own tax advisor. Thank you. And with that, let's go to Q&A.
Okay. Have you a question to start? Cliff?
I don't see a question in chat yet.
No, but I have how to set up, how can someone set up an investment from the beginning to take advantage of the tax laws? But I think what we really should start with is start with Sarah and ask her how is it with what she does? How does that reduce taxes or eliminate taxes? And I think that might be really the question for each panelist to begin.
Okay, so I will begin. Would you repeat the question, please, Peggy?
So how do you either reduce taxes or eliminate taxes from someone who is an investor who owns investment properties?
Right. Okay. So anyone that owns commercial or any residential rental portfolios is subject to bonus depreciation. So what that really means, it's a tax strategy to help accelerate depreciation on your property. And so if you have a residential rentals, you depreciate a very small fraction of that over 27.5 years in a straight line depreciation. And the IRS requires for a commercial property that's depreciated over 39 years. And for tax purposes and for investment purposes, that's a long time for most taxpayers to wait. Many of them agree. So accelerated depreciation really looks at that entity, and instead of depreciating it as one entity, it takes different components out of the building and accelerates that depreciation. What does that mean for you? I will just throw out one of our case samples here, or case studies. Okay, so we did a multifamily purchase in Boise, Idaho. It was purchased 11/20/20. Purchase price was $14 million and change. So the owner's depreciation expense without cost segregation was $261 and change. They were able to expense after the cost segregation study that went up to $18,400,000. So it was an accelerated amount of 32%. So there you go. That's why you do a cost segregation study. It's really the net present value of a dollar. A dollar today is worth a lot more than it is in a dollar in 39 years.
Thank you.
You're welcome.
Dylan, what would you say?
As far as upfront structuring, or
Either
which way do you want to take that?
upfront or how to save or to reduce taxes or to eliminate them altogether?
So for our upfront initial phase setup one, we're running everything through our private 401k or tax credit planning structure, which is going to dollar for dollar eliminate every single taxable dollar that you would put. So if you have a $5 million property that you want to invest in, we would run that individual through our private 401k plan, and every single dollar that they invest through that vehicle becomes tax deductible. So no matter how long you take that, that's how that's going to operate. And then on the asset side of things, since we've already done that pre-tax planning, everything is going to be income or capital gains tax deductible, either way we look at it.
Okay, great. Thank you. Kristen?
I would say with our firm, more often than not, when we're dealing with real estate investors, we have conversations with them about maybe setting up a trust entity and trading through that, using the trust in order to defer the capital gains. And, once you have a trust strategy, there's different strategies that you can use depending whether you're, looking to defer. While you're deferring, there's ways that you can, plan for ways to offset even the deferred taxes. But it all begins with having a structure, a trust structure to begin with, that you trade the asset that you're trading with inside the trust.
Thank you. And where did Gary go? I wish we could have.
He's there. He's unmuted.
I unmuted.
There
There's
you
a lot of noise going on here. Hopefully you can't hear it. There are a lot of people having fun that know each other for many, many years and have drunk too much champagne. I'm always asked, so what can I do to get R&D credits? And as the years have gone by, and the whole R&D program and R&E, which is research and experimentation, sometimes you experiment and you fail and the government helps to give you back some of that money. The things that companies do are very specifically to invest in innovative, creative ways in which they can change their business. And one of the questions the government asks all the time is, how much percentage of time did you spend last year, 2 years ago, 3 years ago? How different is your business today than it was 3 years ago? And we'd all say that since COVID, our business have changed. A lot of our operating systems have changed. So when we work with a client and we look back 3 years the first time, they have no idea what they did or why a doctor or a contractor or a manufacturer originally qualifies for these R&D credits. But going forward, we can clearly show them that if you do certain activities, those activities will be monitored or looked at by, maybe they are monitored with 87,000 more IRS agents. They will be looked at by the IRS as a process that they believe you deserve to be rewarded for, because you built your business in a better way than another business in America, and more so a better business offshore, because all of these credits were originally designed to compete against other countries bringing products and vehicles and services to America. And the Congress was concerned that our country would fall behind, which to some extent it is doing as well. But that's how I can help people save for taxes over the last 3 years and looking forward forever, because the program is part of the IRS code and it is completely funded every year. And so there's no limitation on what we can do in terms of saving business.
Thank you. And R&D means research and development, correct?
Yeah, I'm sorry if I didn't say that. Yes.
All right.
Or Robert and David, if you're buying peaches and fruit and stuff.
Okay.
Well, we had a couple of questions come in chat. And just once again, if you have any questions, feel free to raise your hand under the reactions or put your question in chat. So the first question that we have right now is, I have 2 LLCs, one in California and another in Florida. I've taken depression yearly for past 5 years. Can you still do CS, which I imagine is cost segregation, and for how long? Thanks.
Yes, you are able to do a one-time catch-up or a look-back study. You can go, there is no limit to how far we can go back, but typically speaking, at commercial, it makes sense to go back as far as 15 years.
Wow.
Pretty cool.
That's great.
Did I mention bonus depreciation is decreasing on a step down basis, phasing out over the next 5 years?
So what does that mean?
That means, so right now, just starting January 1st, 2023, you're going to get 80% bonus depreciation, then 60, then 40, and it's going to go down, down, down to 0 over the next 5 years.
And that's in addition to your regular depreciation you take.
Well, so we had at one point 50% bonus depreciation. We could take 50% of that and accelerate it. Then it changed with the Tax Jobs and Tax Cuts Act, and then it went to 100%. So starting January 1st, 23, it's going to go down to 80, then 60, then 40, then 20, then 0.
Thank you.
All right, I think Dylan may want to chime in on this as well.
Oh, I just wanted to ask Sarah a question. With that schedule of accelerated depreciation going away, at least phasing out rather, what's the plan for companies who utilize that as their strategy to pivot whenever that's no longer available?
God, that's the best question ever. And if I had the answer, I'd be super loaded rich. I don't know. I don't know what they're doing. I think what they're probably doing is saying, okay, going forward, we know we have this amount of time, we can get 80%. That's excellent. And maybe they're looking at all kinds of other strategies. For example, if they're a building owner, they might want to, if depending on what they do, they might also be able to get an R&D study. So that's another tax savings benefit. And there are just different ways that they can go with that. As long as they consult their CPA, their wealth advisor, tax advisor, somebody that's really a specialist.
Yeah, I'm very curious to see how this plays out over the next couple of years as cost seg is phased out.
But
Yes.
it's going to be phased out altogether, cost segregation, or just this bonus?
Yes. No. So starting January 21st, 23, 80%. A year later, 60. A year later, 40. A year later, 20. And then after that, 0.
Wow.
But
Now,
that's just
could
the
things
bonus that you
change?
can take all in 1 year. You can still, depending on the segments, take it over 5, 7, 10, 15, and still accelerate the depreciation, but it's not all bonused in the first year like it is now, only 80% next year. That's what she's talking about in terms of the bonus depreciation.
Now, could things change? Well, they changed before, so I don't know. I would hope so, that they would change for even the better, but I don't know. Maybe as we get closer, maybe as depreciation goes down, maybe the laws will change. I don't know. Anyone else weigh in on that? The laws changing, or?
They change with every presidency.
It's like, get it while you can. That's all.
Great.
I think it's just an important thing to keep in the back of the mind whenever considering your tax planning. If you're all in on this one thing and then it's going away or being phased out, just because it does one thing 1 year, be prepared for the following.
So
Well, this one's a no-brainer, though. You know what I mean? As long as you just qualify and the numbers work.
I have a question to Dylan. So Dylan, you've got these, you said how you could set something up at the beginning, but if you're in the middle of, let's say you're 5 years out, you're losing all the cost segregation, depreciation, is that a time that could also then be work with a company like yours and set up an entirely different way of holding properties?
Yeah, we can start no matter what phase you're in. We're just not going to be able to backtrack years back and do some sort of recovery on there. That's not going to be possible, at least with what we do. It's very rare that situation ever happens, at least in the context that it's possible. But if you're in the middle, absolutely, it's just a matter of transferring things and moving things around, creating different entities, trust setups, and so on and so forth.
So it's a transfer, it's not a sale. So it's
no,
not
we would
taxable.
never sell. Never
Okay.
sell.
Great, thank you. Kristen, do you have a comment by any chance on?
No, not really. I think the advisors have touched on all the aspects that I would have in that.
Okay, thanks.
Nika, did you want to weigh in on that or ask a question in follow-up to that?
It's just a whole new question for Dylan, but I can wait whenever.
Okay,
I got a
Someone else has
couple
a question in the chat, so.
I do. I've got a couple of them down there, so we will come right back. So there's a question here, and this seems to be directed to Sarah again. You're quite popular today. Sarah mentioned the commercial accelerated being 39 years, but what about residential acceleration? So was it 39 or was it 27 and a half?
Exactly. So 39 years is the IRS required depreciation schedule for commercial, and for residential rentals, it's 27 and a half years of straight line depreciation.
Gotcha. Yes. All right. Does that answer your question, Tina?
Yes.
Perfect. All right. Next question. Is cost segregation only applicable for commercial or also for residential rental properties? And can it go back 15 years? So I think you actually addressed that you can do a look back for 15 years. Sorry to interrupt. There's no limit to the look back, but it doesn't usually make sense to go past 15 years. Okay.
And then yes, one can execute a cost segregation study on residential rentals. Even if you have one single family, you know, we run the numbers, or whomever runs the numbers, and if they work, they work.
Is there like a dollar amount cutoff where you'd recommend anything below that you might not do a cost segregation for residential?
There's not a hard amount. So whoever gives you a benefit analysis, what should tell, if the cost basis is really low, say $100,000, it's typically, you know, versus the cost of a study. In that case, it typically doesn't make sense, and we'll recommend with that low of a cost basis, after we run the numbers to determine, just there are some different companies out there that do a kind of a do-it-yourself, you know, cost segregation study, and, you know, for a property that low of a cost basis, you know, after reviewing it, we might recommend, and we have done many times, you know, go use one of these DYIs and do it.
Okay, thank you. Gary, this next question may be directed to you. Can you give an example of qualified R&D activities for real estate investors or professional service provider?
That's an interesting question.
I thought it was.
Since I'm very involved in the homeowner association field, I have recovered on average $75,000 for real estate management companies. As a company, I know we've worked with real estate. Now, real estate management is different than being a real estate agent. But if you have a group of employees and you're doing innovative marketing, that's qualified R&D competency. If you're just a real estate agent, it won't work. I don't know for sure. And similar to others on this call, we do all this work for free. So it makes sense to determine whether or not we think you're qualified, because obviously we won't get our fee if you don't get your money back. We also trust you for most of the money that you get back. So there's a process here that there are a series of questions that need to be answered, determining what qualifies. And, you know, I've always been surprised when, I'll give an example this way, and it may be similar to real estate. When a doctor comes up with a treatment plan, in the wisdom of our government, that's research and development. And I never really had a good answer for this for many, many years. You know, obviously they know that if you have certain sore throat, you give erythromycin, and maybe they go back and they look in a book, but the government still thinks that's R&D. But what happened when COVID came around? Nobody knew how to treat it. And so the concept of research and development and research and experimentation, when they give you that antibiotic and 3 weeks later you come back and you say, hey doc, I'm still sick, I finished 21 days. And they go, let's try this one instead. That is what the government is looking at. And when they do succeed in curing you, they now know that that'll work for someone else with similar situations. So it's a very interesting field in terms of what is acceptable and what isn't. And it's really hard to just tell you straight out. I will say this though, and I just want to make sure I get this in. I don't do any advertising, extremely little. Being on these calls, literally meeting all the people I meet. We have a really great partner program. And I would say the average recovery in commissions is $5,000. I know we don't all like to talk about the fact that we make money, but we have to, otherwise we can't afford to pay for Zoom or phones or eat. So my program is set up so that anybody here, even if you don't qualify, you probably know 5 people who do qualify, and they'll at least take you out to dinner if they make get money back from the government. So it's just something to keep in mind, in that I've set my program up now for referrals, more so direct to everybody that I'm talking to.
Thank you, Gary.
Just get in touch with me and I'll try to determine if you qualify or not.
All right. Let's switch from chat. Let's go to Nika. And Nika, you have a question?
Yeah, so I have a question for Dylan. Oh, I sound like, am I echoing?
You're fine now.
You fix it? Okay, great. So my question to Dylan is that you're saying, I heard you say that basically given an example of, you said like $5 million that someone had, if they put it through your 401k program, that then you wouldn't have taxes. But does that mean that they can't have, say they're 30 years old and they give you $5 million right now? Does that mean they don't have access till they're 59 and a half?
Yeah, so it's going to depend. We were able to utilize Rule 72T to gain funds back. If there were ever an emergency for some reason, there's other things you can do inside of that. You can either, if you qualify for 72T, we can do a 72T withdrawal. We can do a standardized withdrawal, which is going to be hit with only a 10% penalty. Or if for whatever reason you need it all back, then you can just shut the entire thing down. Or you can even take a loan against it as well. So the capital is still available to be used.
But at a penalty. And then you got to pay taxes if you try to bring it back out.
Not in every single case. In some cases, sure, not everything is taxes. So unfortunately, not everything's through and through. Some cases, yes, some cases, no. It's going to depend on why you're pulling the money out and what you're needing it for. If you are someone who's going to need, say need that money for income later on, then we're going to run through a whole different slew of strategies to take advantage of those and utilize it that way.
Yeah, because you put it in there and you can't really get to it until.
Well, I mean, you can.
Yeah, till retirement. Yeah, especially for you. You're 20. That's a long time to lock your money up.
I'm not worried.
Yeah. No, I know. I'm just.
If I need it, I can access it. Not a problem.
And you'll get there. I was 20 once.
I know, right? So was I. I know, and sometimes it feels like you can remember the memory so vividly, and it feels like it was yesterday. All right, thank you. Yes, that's it.
All right, so let's go back to chat. So there was another question that came in. This is for a person that has a solo or self-directed solo 401k. Must the custodial annual fee payment come from the 401k funds, or may the fee be paid from the account owner's personal funds? Takers?
Yeah, for us, we just charge the client directly for anyone that we have 401k control over. We would prefer not to take it out of the 401k funds. We want that to sit there and deferment and grow. So we'd rather bill you directly. It's personal preference, though. You can choose whichever one you want it to do.
Okay. Let's see if we have another question down here. I believe this one is directed to Gary. An owner who has many properties and managers for each property, do they qualify for R&D?
There, I would say very possibly yes, because again, you've got multiple people doing multiple things. We have to look at what activities are actually being accomplished and determine whether they qualify under the R&D listings. But that definitely sounds like a more positive direction.
Okay. I don't currently have any more questions in chat right now. And I don't see any hands raised, so I'll kind of throw this out. Kristen, what would be some strategies that you might, recommend to someone to consider for tax planning or preparation in advance before they actually are hit with all the taxes?
Well, since we're primarily speaking to real estate investors here, I think one of the unique strategies that not everybody has heard of is something called private placement life insurance. I don't know how many of you may have heard of that or not, but that's a bit unique in this space. So most of us probably are familiar with all the tax advantages of life insurance. And so there is a way to invest in income properties inside of a life insurance policy. So, most life insurance policies that we think of, usually the assets are either, say, a whole life policy where it's not in the market and it earns interest based on, a minimum interest credit plus dividends. And then we have universal life policies, which tend to be either market correlated or truly in the market if it's a variable universal life. So usually that's what people tend to think of the types of assets that you can be investing in, so to say, if you're using the tax protection of a life insurance chassis. But there is another animal called PPLI, or private placement life insurance. And you really have to work with a specialized team. I do have a team that is going to be like the largest team in the United States. I would say more of these policies are much more popular in Europe versus the United States, but so it's harder to find a carrier in the United States, but it is something that's growing in the United States. But that's a very interesting way to be a real estate investor and really enjoy the tax benefits of life insurance.
So just kind of dovetailing on that, with your private placement life insurance that you were describing, you can literally put a property in that?
Correct. Yeah.
I've heard of borrowing against the policy and using the money to invest, but can you elaborate on that a little bit?
Yes, it's a form of variable life insurance. So it's considered like, it's considered an investable asset. And instead of being like a stock or a bond, let's say, it's actually a life insurance policy. Some people even put crypto. You can actually put a lot of different assets inside of a PPLI, but real estate is a very popular asset to put inside a PPLI wrapper.
Oh, that's really, really cool. I'm glad that you brought that up. I've never heard of that. Thank you for that. So let's go to David. He's got his hand raised. Dave, if you'd unmute yourself, please.
Yeah, thanks, Cliff. Can you hear me okay?
Yes, we can.
Okay, great. Yeah, I was in a crowded restaurant as well, like Gary, but a little bit more loud. But anyways,
do you have champagne too?
I wish. Well, I'm not a champagne guy, but yeah, it's during the week, so I guess I gotta wait for the weekend. Anyways, yeah, I just had a question in reference to other types of investments, in particular the opportunity zones, and if there's some sort of like government involvement or grants, things like that. I just want to know a little bit more about that on a tax basis.
Okay, I'll speak. This is Sarah. I have heard of those, and I've never worked with anyone who has done those types of activities. So.
I know at Redwood, because they're pretty highly scrutinized these days with the IRS, we aren't really doing a lot of those. We do have a referral partner that I'd be happy to share that they're doing it right. It's a company that does, some very good work in the opportunity zone space. So I'm happy to share their contact information.
Oh, that'd be great. I appreciate that.
Sure.
And I wanted an answer because that's an interesting question. You already get a significant tax break for being in an opportunity zone, but I don't see why, and maybe I should make one thing clear. You need to pay taxes to get R&D benefits back. So if you've been in business for a few years, and again, some client companies get referred and By the way, R&D works best if you're an LLC or an S Corp, because the tax benefits flow down directly to the owner or partners. If you're a C Corp, you'll get some money back depending on the amount of revenue and payment of taxes that have been occurred, but it will be significantly less. So it's important to know that as a company, if you generate revenues of 1 million to 20 million, you're probably going to look at somewhere between 50 and 125,000 recovered if you've paid significant taxes within those last 3 years. And that's a very significant amount of money back to any business owner. Again, most of us on this call probably aren't paying 100,000 in taxes, but 500,000 in taxes, which when I get referred by CPAs, and their financial advisors, they've saved as much money for the business owner as possible. And they go, all right, we'll see if Gary can save you some more. And everything we do is completely 100% legitimate. These are credits. And by the way, they can be used as credits. Sometimes when you're selling a business, instead of taking the cash, you leave the credit on file, and that credit can be a multiple of 2 or 3 times when you're selling your business. So I've done that as well. But as I can see where if you're in any of these opportunity zones and you've been in business long enough, 2 to 20 employees, 1 to 20, 30, 40, 50 million in revenue, you will get a significant research and development tax credit back. So again, since it's free, everybody should at least try to see if they qualify. It is not hard. And I've had so many CPAs be surprised because they'll say, oh, you don't qualify, or you don't make enough to qualify, or it's not worth it to qualify. And very seriously, the answer is that they aren't qualified because they can't back up their work because they're not an expert in this field. And if they had to go to the IRS and defend, they wouldn't be able to. And I'll also say the question I get asked all the time is, will this lead to an audit? Well, we've worked with 15,000 companies now, and we've never had an audit directly related to R&D credits. Could it happen? It's possible. And I want to just give one other example. Last year, we had over 20 companies receive more than $1 million. Every one of those is under consideration. But everybody that's 100, 125,000, it's like the magic number. The IRS looks at it, they check our calculations. Sometimes they give us more money than we even calculated, which has happened. I had one client got 25,000 more than what he was supposed to get, which I didn't call the IRS and say, oh, how did you figure that out? Why did you give us more than we told you you're supposed to? But that's rare. But all the $1 million cases are questioned with paperwork only, not audit-wise. And out of 20, we have settled 18 of them in the last year in our favor, or client's favor. So that's, if you dot your I's, cross your T's, and I'm sure Sarah will agree, this is a very qualified system that goes through extremely well, because I've done post segregations for Section 8 housing and others similar to what you were talking about, Sarah. And nobody should be afraid to do this or recommend someone to do it.
That 100%. And unfortunately, or maybe fortunately, a lot of CPAs are very reactive and not proactive. So they just may not feel comfortable, or they don't know. But once they do these types of tax studies, their clients are very happy.
Right, which is why they refer out business like this. They're good at filing your taxes, but not necessarily at learning and knowing everything. That's why they're a specialist. Like I said earlier, you don't go, you got something wrong with your heart, you go to a cardiologist. Well, we're brain surgeons and cardiologists, and probably, never mind, I won't make a bad joke.
I'm glad, Gary, that you brought that up, and Sarah, I'm glad you responded to that. I've run into that myself, and I think it's really important whenever you're working with someone that you've been working with for many years, and you bring a new concept to them. The people that you're working with that are presenting that new concept, it's really good to have a conversation with them so you understand how to present this properly to the expert that you're working with, so that you can find out if they're even qualified to respond by asking them questions before you just drop it in their lap. Because if they don't know it, they're apt to kind of poo-poo on it and kind of dissuade you from moving in that direction. So you really want to make sure you're qualifying the expert you're working with and not just dropping something into someone's lap because you think they're an expert.
And I'll add one more thing. Kristen is an expert in the ERTC credits. There are people on the radio promising all across this country that are going to get you money back on this, and there are even R&D people, not many. I question those who are on the radio and promising more than they can actually provide. It's a serious business in the tax area, and we take it seriously, and we're all very professional about what we do. And when you're working with myself or Kristen or any of us, you know that next year you're going to work with us again. I have a lot of clients that have gone to Price Waterhouse, and they charge $50,000 just to evaluate if you qualify. And maybe if you're a $50 billion company, you got a CYA and you kind of go to them. But the next year, when you go back to do it again, because everyone does this in 24 and 25 and 2030, it's not going away. You get another new set of young people. Not that there's anything wrong with young people, but there are people that you don't know that are now not familiar with you or your company year after year after year. When you work with people like us, you know I'm not quitting. It's my company. How can I quit?
Your wife will make you quit.
What wife that I don't see? I don't have any time.
All right,
Okay,
we'll come back to
one.
that, Gary. David, you've got your hand up. Let's go ahead and address your question.
Yeah, can you hear me okay?
We sure can.
Okay, great. I had a question reference to business structure. An LLC, in particular, if you had your properties in an LLC and you wanted to take them out into a trust, the individual's trust, instead of grouping them in an LLC, just curious on that, on the tax structure, and obviously it's better for anonymity, but just wanted to get your take on that.
I would think it depends on how the trust is structured, but I would imagine you could transfer that like you would transfer it from one entity to another via quitclaim. Would anybody else like to chime in on that?
I'm not sophisticated enough as a CPA to answer that question. You need a trust attorney.
Yeah, I was about
Kristen,
to say a
though,
trust attorney would.
Yeah, Kristen said she deals with trust a lot, though.
Yeah, my team does, and we do literally like every type of trust that can be set up. But you're right, we would have our tax attorney's trust division do that. So I don't think I'm qualified to speak on the specific tax implications of that transfer.
Okay, all right. Yeah, I guess I'll further with that. I'll get your information, but
I assume, David, you won the lottery and you want to put everything in a trust so they don't know your name with the $1 billion that you won?
Well, I wish. I would, hold on one second.
Well,
I would invite you guys to enjoy it with me, but no, I mean, not yet, I guess. I just trying to be more anonymity, trying to go that direction because, with the LLCs and having multiple properties in them, I'm just want to change that structure.
Definitely ways that you can do that. That might be good for a different call, though.
Mm-hmm.
But thank you for that question. I wish we could answer that a little bit more in depth.
And briefly thinking about the question, at least for R&D, I'm not sure you'd qualify if the trust was the owner. That's a good question, more sophisticated than even I know the answer to. I'm sure that I'm going to ask somebody so I know the answer next time, or at least within general terms. But that's an interesting point because, as I said earlier, these credits flow to the individual tax return, which is filed by the owners or partners of a company. I've had situations where one partner was recommended to me, and the other two partners were fighting with him. I got him back $150,000. Now all of a sudden the other two partners are friendly and want me to do it for them, but they wouldn't do it at first because they hated him. So by dint of that, they didn't want to talk with me either until he waved the check in front of their faces. And then all of a sudden we were friends again. It's been very interesting in terms of dealing with people. And that's why you need to work with serious people, because it's a very serious business when you're getting clients back money. And I will tell you again, the greatest pleasure is seeing someone get a $25,000 check, or 6 of them, because they state and federal every single year is a different check. The first thing I tell the client to do is take a photo of that check on your phone and send it to me so that I know you got it, and then send it to the next 5 best friends who own a company bigger than yours and have them call me on Monday morning after you golf with them on the weekend. And that's how all my referrals occur.
Thanks, Gary.
I had another question, if I may, if there's time.
All right, we'll make an exception. Go ahead, David.
Appreciate that. You're the guy. You're the guy. Oh, man, of course. So anyways, I do have a question with 1031. Now, this is a different kind of a 1031 exchange question. So rather than the typical sell, find the property and then close on it after the fact, my question is, if it's a different type. So if I, rather than do an exchange, actually giving my property to a partner into their property as in a partnership interests, whether just 2 other people, 2 people, myself and somebody else in their own project. So I'm trying to increase my value or my income by doing so, rather than doing the traditional way of hopefully finding something, especially in this market. So basically, giving my property up for an exchange of for that, and also be a partnership in their property.
Are you asking if you can or can't?
I know you can. It's just that there's details that I think from a standpoint of the 1031 direction, I've heard a couple of different ones. So it's like I'm just confused.
I guess which out of all of that was your question? How?
Yeah, I was going to say how, and then what is the tax complications, or if there is, or whatever.
That's probably a CPA question. We have a fund. We're not working with that group, but the fund will accept exactly what you said. And I looked their fund over, and they accept properties in. So you're gifting, you're not exchanging, but now you are in the fund with your property, and that property then becomes a part of the whole of all the other things that they own. I do not know how it's done, and I did not speak to my CPA about that.
Okay. Yeah, I'm not talking about a fund. I'm talking about it being a single
It's the
partner.
same thing.
I don't want to do any funds. Does it make any sense for my portfolio? So
no, I'm not.
Just more of a trade exchange kind of thing.
So are you trying to exchange of partnership interest in a 1031?
No, he's not doing a 1031. He's gifting the property to.
Okay, so he's doing it without.
He's gifting the property to the next person in order to then be a partner inside of that whole, inside of that ownership. So he basically becomes a partner in that.
Well, if he's gifting it, then it goes against his gift tax allowance. So someone's paying gift tax, whether it's you or the other individual, however you want to divide that up.
Yes, yeah, you got to talk to your tax attorney or CPA person to advise you. That's above our heads. We didn't bring any CPAs on here.
I need my lawyer.
Yep.
Okay, well, I appreciate that. I just wanted to get some possible insight. Anybody's done this, so but yeah.
I was thinking maybe you could talk to the people that have the fund, because they do it all the time, they said. And maybe they could tell you who to talk to about, or tell you how that works.
Okay, that's a good idea. All right, great. Thanks, Megan.
That was
all right. So we're coming down, to the wire here. We got 2 questions left in chat and 1 hand raised, and maybe 3 questions now. So we might try and go through these quickly. Kristen, are there maximum limits of the PPLI, and can they be diversified?
They can definitely be diversified, and the maximum limits are going to be very similar to maximum limits for other types of life insurance. It all has to do with the proportion of your net worth. So that's going to be on an individual basis, but generally speaking, the limits are quite high. So that's usually not a limiting factor. But yes, and diversification within the same policy, we'll call it, or the same shell, yes, you can have multiple assets inside one policy.
Very
With
nice.
the,
Thank
with
you,
the
Kristen.
PPLI, don't you have to have multiple?
Yes, you have
'Cause
to.
I think you can
yeah,
only have
because no one
55% in
asset
the
can
one
be more
asset.
than a certain percentage.
Yeah, it's 55, 70, 80, 90, 100. So I think it has to be spread across 5.
Right. And usually, sometimes we'll have clients that will just have, other investable assets that they'll put as a portion of it just to make the balance. But you're absolutely right, Dylan. It does have to be diversified.
All right, thank you both. Next question. My LLC bank account provides a debit card with which to pay LLC expenses. However, some expenses cannot be paid via debit card, i.e. car rental, and I have to use my personal credit card. To claim these as LLC deductible expenses, what can I do such that the IRS would find my deductions acceptable?
I can answer that.
Go for it,
I'm not
Peggy.
on the panel. You do your bookkeeping and you transfer that into the business with the receipt and a copy of the charge. And it becomes your business expense because that's what it is.
Or simpler than that, you just ask for a business credit card that has a Visa and not a debit card too.
Right. That would be the easiest thing to do. Your LLC gets the credit card.
Okay, one quick question here, and then I'll go to Kurt, who has his hand raised patiently. ERTC credits, what are the acronyms? Acronyms can be misunderstood. So I guess he's asking what it is.
Yeah, I can certainly answer that. So ERTC, also referred to as ERC, stands for Employee Retention Tax Credit. So this is a tax credit that is related to it's a COVID tax credit, and it's meant to reward businesses who maintained employees during the pandemic. And it's a payroll tax credit. So it can be very lucrative to those that have employees, and that if you maintained employees during the pandemic. And in fact, you could potentially get up to $26,000 of refundable tax credit per employee.
Very nice. Thank you so much. Kurt, let's go to you.
Okay, so this is probably a CPA question, but since you guys have been doing this a whole lot longer than me, it's related to K1s. I keep on getting these emails and letters saying that I've got to be prepared to utilize my K1s for tax purposes, but the investments that I have are all within the self-directed 401k. I guess, I'm going to laugh when I say this, but can I just ignore them because they're inside my 401k, or do I need to actually do something with them during the tax year when I submit all my stuff to my CPA?
Well, I'm not a CPA, Kurt, but I would say you should supply them to your CPA, but they don't count because obviously that money that you've received through the K1, whether it's phantom income or direct income, is not taxable because of where it's located. But I would still supply it to them. You may need sometime in the future to be able to recapture something. I'm not sure, but anybody
It's
else?
deferred. It's deferred. Yeah.
Correct.
Yeah.
Yeah. At
Yeah,
some point, he'll
you
have to pay taxes.
So what happens, I guess, when I have to take mandatory distributions and when I'm 72, I'm 65 now, do all these things accumulate, or is it only the current year that you have to really be concerned about when you start taking money out of the 401k?
I don't understand the question.
Well, I'm
There's
getting
a certain percentage that you have to take per year. There's a certain percentage that you have to take per year, and your CPA will tell you.
What he's asking.
That wasn't the question. The distribution amount. I know how to get that access to that, but the K1, do they all lay on top of each other when I start taking distributions, or just the last year when I start taking them?
Well, it's not that easy of an answer. You may not be an owner of any of whatever was at a K1. You might be all in cash, or you might be in other deals. So they don't really have anything to do with it. All they do is look at what the value of the whole is, and then take that percentage, and that's what you have to take as a RMD. Doesn't have anything to do with the K1s or anything else. They just go against what the current value is and tell you you've got to take this much money, and then that's what you owe taxes on.
I would definitely suggest turning in the K1 to your accountant and have them factor that
Absolutely.
into your taxes. Taxes just don't go away. So if you have to pay taxes, they'll be deferred in the 401k until you have to start taking your RMDs. And you definitely want to, because if you don't, you're taxed at 50% of whatever you were supposed to take out but didn't.
And here's one more thing. IRS does not track year to year to year. They only work on the year they're in. So they don't look at last year.
Okay,
Yeah.
that's fair. That's the answer I was looking for then.
Okay. Yeah, and I give everything to my CPA on all my IRA stuff.
Got it. Well, thank you.
And there was you're welcome, Kurt. Thank you. There was a question, what's K1? So can someone explain what that term is?
It's the
It's
K,
just another tax form.
it's the K before
No.
K2 and after K0.
It's just another type of tax form. It's just like a W-2 or a 1099 or 1065. It's just another type of tax form that's used for other purposes.
So what the K1 form is for is when you are invested in a particular, property is the only way I've seen my K1s. You're invested in a property, that's where the depreciation comes through. So it shows what the income is on the property, and then it shows what the depreciation is on the property. And usually then it shows what your original amount was, and every year that comes down. And it's always good to read your K1 because it's a return of your investment on paper, just on paper. And so and then your CPA will take whatever that is, and you want that to be a big minus number, because then that comes off of whatever your income is over the year. So they're deductions. That's one of the ways that you lower your income tax, is using your K1s. Did that answer the question?
Yes, thank
Okay,
you.
good. Thank
There
you.
was one comment that came in chat here. It says, in general, records of financial transactions should be kept separately by entity.
Yes, it should. Thank you for that. I bet that came from Ted.
It did.
It did. So thank you everyone for attending today. Thank you for all the questions. We're so glad that you know what you know about taxes and don't know what you don't know about taxes. So be sure that you have a good CPA or tax attorney who can walk you through and answer all your questions. With that, thank you, each one of you, for being here today. Sarah, Kristen, Dylan, and Gary. We really, really are so happy you were here.
And thank the
you,
audience
Cliff.
for your participation and questions. Without you, we wouldn't have had such an incredible panel today.
That's
Thank
for
you.
sure. Thank you.